So there is this concept of economic territory. Economic territory is the geographical boundary of a country. And that geographical boundary includes certain things besides obviously the land. It also includes the waters and the airspace. The geographical boundary includes that also. It includes embassies, consulates and military bases abroad. It includes ships and aircraft operated between two countries. It also includes fishing vessels, oil and natural gas rigs, which you could be operating in international waters. So all of this includes the economic territory. Now, in this economic territory, people from many countries could be operating. For example, if you read the news these days, there is a talk of Foxconn, which is a Taiwanese company manufacturing iPhones in India. So a Taiwanese company is going to manufacture iPhones for an American company, but it's going to be in India. So there are three entities involved, right? Now, India, the part that India plays is that the land is India's, the labor is India's. Okay. American company is the owner, right? That is, he's the owner. So he's the entrepreneur, let's say. The American company is the entrepreneur here, and the Taiwanese company is the manufacturer. So land labor, let's say it is part of, it is, let's say it's providing a bit of labor and a bit of capital, a bit of some factors. So there are three entities involved, right? Now, when you want to calculate the income generated by, let's say, the Foxconn factory in the Foxconn India plant, okay? So when you want to calculate the income generated by the Foxconn India plant, in whose income will you add the profits generated from Foxconn India? Will it be Indian? Will it be American? Will it be Taiwanese? On whom? To whom does this business venture accrue? So that's why there is a difference between the economic territory and the normal residents of a country. So you could be a resident. So Taiwanese are a resident of Taiwan, but they are running an operation outside of their home country. On the land of India, people from outside can do work. Mukesh Ambani may have a factory outside. Recently, it came in the news that Tatas are going to build a $4 billion semiconductor plant in the UK. So who owns it? Like, in whose income should that semiconductor plant go? So that's why there is a difference between economic territory and normal resident. So first, the definition of normal resident. A normal resident is a person or an institution who ordinarily resides in a country and whose center of economic interest lies in that country. So let's say Mukesh Ambani. He is a person who resides in the country. Ordinarily resides meaning he is living in this country for more than 6 months in 1 year. More than 6 months in a year. Okay, you are in this country, so you're ordinarily residing in this country and your center of economic interest, like bulk of your business is here. So then you're a normal resident, all right? So based on these two concepts of economic territory and normal resident, because it's not the same. It's not that all Indians only work in India and all foreigners only work in foreign. There is so much to and fro. So we define two concepts. That concept is of domestic income and national income. All right, so the concept is of domestic income and national income. Everything that is produced or in the economic territory of a country gets added in the domestic income. Okay, so everything. So this Foxconn, the output of this Foxconn factory will come in the economic territory of India. All right. So the output of the Foxconn factory will come in the Indian domestic income. Our GDP is going to rise because of this. All right. So domestic income stands for NDP at FC, net domestic product at factor cost. Domestic income is called net domestic product at factor cost. So how do we calculate it? You get GDP at MP, let's say, from the expenditure method. You subtract depreciation. You come to NDP at MP. You subtract net indirect taxes. You get to NDP at FC. This is the domestic income. Now, from this domestic income, we do another maneuver. What we do is, we take this domestic income. To this domestic income, we add all the income which is earned by Indians from abroad, right? The term is simple. Whatever is the income earned by Indians from abroad, you add that here and you subtract all the income earned by foreigners in India, okay? And when you do that, this domestic becomes national, and NDP at FC changes to NNP at FC. This is called the net national product at factor cost. and this is called national income. So like the domestic income accrues to the domestic territory, the national income accrues to all the residents, normal residents of a country. So the income of all the residents combined is the national income. Okay. So whenever we talk about the national income, what we are talking about is income of Indians, not income in India. It's income of Indians. So that is the income of the residents of a nation. That's national income. So this entire thing, the subtracting of income accrued to foreigners and adding of income earned by Indians from abroad, this term is called NFIA, net factor income from abroad. So let's look at NFIA in a little more detail. So national income is the income held by the residents of a country, whether residing in the domestic territory or abroad. It is the income earned by the current factors of production. It's NNP at FC. So NNP at FC is NDP at FC plus net factor income from abroad. So net factor income from abroad, it includes three components: net compensation of employees, net income from property and entrepreneurship, and net retained earnings of resident companies abroad. So these three components we've discussed before. Net compensation of employees loosely translates to net wages earned. So this net word basically means that all the compensation of employees earned by Indians abroad, earned by normal residents abroad, earned by normal residents abroad are, so this is what is added, and what is subtracted is the income, or sorry, we're talking about compensation of employees, let's say. So the compensation of employees earned by foreigners in India. Okay, that's the meaning of net. What we earn is taken, what we paid is subtracted, and the difference is the net. So net compensation of employees, net income from property and entrepreneurship. So if some of your relatives own a property in Dubai, their income is added here. If a foreigner owns a property in India, his rental income is subtracted from here. So that's net income from property and entrepreneurship. Then net retained earnings of resident companies abroad. So companies which are operating outside, they pay their profit as dividends to shareholders. And besides that, whatever they keep with themselves inside the company is also a part of NFIA. All right. So these are the components of NFIA. Together, this is called the net factor income from abroad, which must be added to NDP at FC to arrive at NNP at MP. So another way of looking at it is what came in the question that we just discussed. Factor income received from abroad, minus factor income paid to abroad, right? So this is whatever is received minus whatever is paid. All right. So these are the different ways in which net factor income is calculated.